Hey everyone, welcome back. It's my pleasure to announce our next speaker for the TraderLion conference, Mark Ritchie II, who is a managing partner and portfolio manager over at RTM3. He was also featured in Momentum Masters alongside Mark Minervini, David Ryan, and Dan Zanger, and he's also an analyst for Minervini Private Access. Mark, thank you so much for being here and welcome.
Thanks for having me, Richard. Good to see you again.
Yeah, good to see you as always, and really looking forward to this presentation, diving a little bit into your background and also the lessons you've learned along the way. So yeah, the floor is all yours.
Sure. So yeah, the title of this talk is What I Learned Working with a Market Wizard. And this was something that Mark Minervini and I actually put together this presentation together in a little bit of sort of a retread of what have I learned under his tutelage at sort of essential lessons in the last 10 years. And he was asking me the questions. We were going to do this together, but due to some of his schedule constraints, he couldn't. So we just sort of put this together and thought, yeah, I'd walk you guys through it. Before getting into it, just a real quick disclaimer. Nothing that I'm saying should be construed as investment advice. Obviously, do your own due diligence. This is, not, it's for education only and not an offer or enticement to buy or sell anything. Please, adhere to good risk management principles. So, yeah, that being said, Richard, you mentioned, I was fortunate enough to be featured in Momentum Masters sorry, having trouble going to my next slide. Yeah. With Mark, David Ryan, Dan Zanger, a number of traders who have a breadth of more experience than I do, and now I have the privilege, of course, of working side by side with Mark. This year is really kind of one of those things coming full circle for me personally. This is a little bit of a soft plug, if you will, for the Master Trader program. But the irony is, I didn't know Mark from Adam. He didn't know me. I went to the first one in 2010 with almost no money and a little bit of, I'd been trading on my own for a little bit and trading in general for a few years, but just eager to learn like anybody else. And this was sort of really one of the major catalysts for my success and helped me put a lot of things together. The timeless principles that we talk about. The program is better than ever. I know because I've been to almost all of them. I believe you've said it as well, Richard. The nice thing about this year is that there's going to be a full second day of Q&A. So it's 4 days of content, 2 days of Q&A, and a day of live trading. It's a real honor to go from a student to a co-instructor. Very appreciative, obviously, Mark for doing that. But just so people know as well, I was a student and a client of Mark's MPA, those type of programs. So I wouldn't put my name behind anything any course that I haven't been through and haven't learned a lot from. This some quick stats about myself. I've been trading for 15 years. As I said, went to the original Master Trader program, was fortunate enough. In those days, there was no, trading derby or a U.S. investing championship like it's currently going now. So Mark sort of did his own. I was fortunate enough to win. That's actually how we got to know each other a little bit better. The winner in those days, Mark said, hey, if somebody wins this contest, sends me their trading record, I'll fly out here. You can sit side by side with me in my office for a day. So I said, well, that seems like, a worthy endeavor. So yeah, really just studied the strategy, become a student of it like anybody else. And, took 100,000 into over 20 million. The other person who I should give a lot of credit to is my co-portfolio manager and one of my best friends, Brandon Hedgepath. He went with me as well, was even probably poorer than I was in 2010. We both were just trying to figure this business out and decided to go together. And we've been in the trenches together ever since. Now we're both analysts at MPA. And as I said, because it's just a product we really believe in and trying to keep people at the very least adhering to really good, risk management principles, trying to keep people on the right side of the equity market. And and just doing much better than I think they would be otherwise on their own, and providing education. Look, guys, it's an education thing. That's what I know, Richard. That's what you're trying to do here. How do you educate people and help them be better traders and investors? The reality is markets charge tuition. So would you rather pay it to someone who knows what they're doing, or just sort of slog it out, trial and error and those types of things? So, and it's just, there's no shortage of experts. I do think, though, there are probably a shortage of experts who really have really solid track records. So speaking of which, this is, just sort of annuals of our track record. Not saying it's the best out there, but something we're pretty proud of. What I really want to get into, though, and the good stuff, as I like to say, is the vacuum-packed, insulated process that this style of research and trading really offers you. And what I was skeptical of early on, and a question I often get a lot of the time, is how did you make this good market call? How did you know when to be in cash? How did you know when to start investing again, and those types of things? And what I normally always tell people is you have to have a process. And your process has to keep you insulated. And what I mean by that is where you are playing your game and not somebody else's. Or, for example, your process has led you to a position or opinion on the market, and you're not going to let an economic data point, somebody else's opinion, influence that. And I think one of the biggest advantages that's also an extreme disadvantage is the fact that everybody now has the ability to trade any market, anywhere, anytime, on your phone, on computers like we're on right now. I mean, you can get up in the middle of the night and trade, currencies, other global stock markets, cryptocurrency, all this kind of stuff. That's an incredible advantage, but the noise factor is the incredible disadvantage. And I think you and I have talked about this in the past, Richard, but the reality is your process should automatically keep you insulated in a way that you're focused on what you're doing. So meaning that it doesn't matter how scary things look or the headlines are or those types of things. You're simply following the market. And probably this is one of the biggest lessons I can remember early on, being very skeptical. I had the good fortune of at the very first Master Trader program I went to, there weren't a lot of us there. And I was sitting next to a guy who was a former institutional client of Mark's, I think from the 90s. I won't mention his name. He's a very private guy, but he's a very successful trader and somebody I want to becoming pretty good friends with. And I said to him, so you're telling me if I just screen stocks and sort of go through this routine and this process, that they will guide me? I don't need to look at all this eco-fundamental data, and I don't need to watch news and all these other things. And he goes, yes, that's exactly what I'm telling you. And he had been, again, he was a client of I think Mark's back when he was selling institutional research on Wall Street in the 90s, but then had been an independent trader himself for over a decade and had been very successful. And like anybody, I just thought that seems a little overly simplistic. The reality, though, Richard, is nothing could be closer to the truth in terms of how simple it is. Simple in theory, hard in practice sometimes. And especially now, because now not only do you have instant news at your fingertips, you've got financial Twitter and a zillion opinions. And of course, everybody's an expert on everything all the time. Where if you have to have a process that allows you to ignore all that. One of the things, though, I remember Mark said was that in his old shop, he wouldn't even let people bring in newspapers. He wouldn't let them bring in other firms' research. He wouldn't let them, and nothing else was allowed. because he didn't want anything causing, any type of a distraction from, again, their vacuum-packed process and how they were doing things. And I can't underestimate how much that has helped me in the long run. And really, one of the best examples is, after COVID, there was an extreme amount of fear and pessimism, as I'm sure you remember, and anybody who has been doing this for longer than a few years will remember. We had this enormous break in the market, but the headlines were rightfully so pretty scary. And there were sort of twofold, if you remember. It was global depression, or people calling for 1929 in terms of the economy all over again, those types of things. And then, of course, there was is this going to be the Spanish flu where 5% of the population dies because of, multiple waves? And of course, everybody was convinced there was going to be this massive second wave. And lo and behold, we had, I think, a risk model buy signal in early April, and then stocks started setting up around May. And it was, if you weren't sticking to your process, you wouldn't have been buying them. And I know lots of people said, I'm gonna follow the news and not the process. And they just missed out on what was an incredible opportunity. And there were actually multiple incredible opportunities. So, one of the biggest things I learned, and I'd been doing this for a while. It wasn't like I was brand new. I've seen many iterations of this, but this was one of those scarier ones, where you're sitting there going, I'm not so sure. And this really, I think, translates to maybe even the environment we're in now. We're in a bear market. Pessimism, based on a number of the sentiment measures, is very high, meaning that people are extremely skeptical and negative. And I have a feeling, I don't know, that we may see that even get worse, or specifically, you're going to see calls for global recessions increasing, or that sort of that narrative that the economy is really gonna sail off the cliff because the Fed's over tightened and all those types of things. And I'm saying this is a perfect time to adopt an insulated type process. What is going to have you buying regardless of what anybody says? And that's the power of a really good process. Specifically, what we're doing at minervini Private Access, the types of things Mark and I teach, is follow stocks. It's a market of stocks. If you want to follow news, go to journalism school and or figure out how to be a reporter, because if those people were good at trading, that's what they'd be doing. Their job is to push out headlines. A lot of these headlines are stale or old. Same with economic data. I'm not saying you completely ignore 100% of all news, but the price action and specifically how stocks are acting. You can read those headlines, but you cannot let that into your decision making when it comes to trading. So that's sort of paramount commandment number one, if you will. The second thing I would say, that has really been paramount to my success, but one of the things that I've tried to teach, and it just becomes axiomatic, is the idea of always thinking risk first. And almost every successful trader I think I've known, if they either do this intuitively well, whether they would use this kind of language or whether they think about it, but that they're always calculating or trying to get odds on their money, if you're using gambling terminology, or they're trying to make good risk adjusted bets. And what I mean by that is, on average over time, their expectation is to be way ahead, because they're thinking about the relationship between risk reward, and specifically then creating that asymmetric relationship. So whereby they can be wrong 1, 2, 3, 4 times in a row, but very quickly, once they're right, make all of that money back and a lot more. People are often surprised when I tell them, I'm usually wrong a little more than I'm right. And well, how could that be? Well, because I'm I'm structuring in asymmetry. I'm layering in asymmetric reward to every decision I make. And this plays out in a few different ways, but I think one of the most important is this idea of if I like an idea, or let's say it's, in most cases it's a stock. I want to buy a stock, but I can't find a good low risk way to get in, then I have to either wait or just pass on the situation because I want to get multiples of my risk. So, and this is one of the reasons why stocks or markets that are wildly volatile, and the way I would define that, or we would define that, is that they are carving back and forth in huge swaths. A mistake people often make is they think a momentum situation is very volatile. Not necessarily. Usually that, if that momentum is moving one way, that's, we would define that as alpha, not volatility. It's that knife that's cutting back and forth that can really cut a sort of low risk directional trader to shreds. And so, yeah, I am trying to find a way to get on board something that I think has a potential asymmetric payout. I can't understate this. This may seem remedial to some folks, but that is ultimately what is driving a lot of my decisions. So maybe I love, a certain story, a certain stock, a sector, or I really find it interesting. But if I can't find an asymmetric way to put it on, meaning that where I'm right, I'm going to get multiples of my average risk, then I either have to pass or wait. The next point, which is something that I've always been a believer of and was doing even before coming to, something like, Mark's seminar or under his tutelage, is the idea of tracking your trades. He calls us knowing the truth about your trading, but it's the idea of rolling up your sleeves and really getting in the trenches within your own results. So I am blown away both as a trader at the number of supposed professionals who don't either do this or know this. And what I mean by do this is track this stuff. And then if they do track it, really getting in and studying the results. And there are some successful professionals who I know that don't, but it's only either because they've done it so long where they know where their average metrics are that they don't really track them anymore, or it's become so axiomatic that they cut their losses so quickly that they haven't really sort of geeked out on the stats and the numbers. But if you are new, and specifically if you're having trouble, this is probably the most underrated portion of a trader's arsenal. And the reason is because when you actually take a step back, stick everything you've done on a spreadsheet, it's staring you right in the face in terms of what you've actually done. So it's real easy. You and me could throw up a bunch of charts, a bunch of ideas, and I could give you these ideal buy and sells, and everyone could then, go home and say, oh, I'm going to do this perfectly. The reality is the real world, it does not work that way. We have emotions, we have feelings. Sometimes we don't get enough sleep. We wake up in certain moods and do things what seem like for bizarre reasons. This is why putting all this stuff down, tracking it and looking at it, it's staring you right in the face. So when someone is having a rough go and they go, I just don't know what's going wrong, this is where you need to start. What is your average win? What's your average loss? What's your win rate? That's where you should start. And I would encourage people to know those things sort of in their head, because what will happen sort of axiomatically is you'll know that, hey, on average, this is where I tend to have an average loss. That tells you then, if you want to my previous point, always be asymmetric in your risk reward relationship, that you need to be going for multiples of your average loss, say for your average gain. And then, of course, your batting average. At what percentage of the time in a normal market is my expectation to be right? The reason I say, hey, I'm often wrong more than I'm right is because I've done thousands of trades and my win rate is right around 40%. So I, even emotionally speaking, know that on average, when I place a trade, 6 times out of 10, it's going to be a loser. Well, that has a little bit of an emotional advantage as well, because I'm not going to get too wrapped up in any one trade if I know, Richard, on average, that all things being equal, losses are a regular part of my game. It also helps you spot tendencies. And I think this is also really underrated. So, and I would encourage people to track this, put the trades in as you execute them. So some people do it, say when they close a trade and they go back and they put where did I buy it? Where did I sell it? Win, loss, what were my percentages? That's fine. Some people do it in real time where they just put down the buy and then they put down the sell. But I would revisit it then in a month or two, and then really take a hard look at the trade. Once you're sort of, removed enough to say, was this a good buy? Was it a good sell? What was I doing here? Did I follow my plan? That would be the other thing you could also do. And if you're new at it, I would encourage people to do that. To even, especially if you have a hard time in the trenches, in the moment of battle, actually doing what you said you were going to do. Well, you can put that down too. I bought XYZ position and I was going to do, A, B, and C. I'm going to stop out at this point. I'm going to you make the plan even as detailed as you want. Maybe you've got a couple of different spots or multiples of risk, or I'm going to set an alarm at a multiple of my risk and see how the stock is acting and take off a portion and hold the piece for a bigger. However you predefine that plan, you could even put that down and follow it, and then come back and see and reevaluate. Was my plan good? Did I follow it? What are my tendencies? And often, though, what people find is they have some strengths and weaknesses, and this will come out in the numbers because we are nothing but a reflection of the way that we trade. In terms of our trading is an expression of who we are. So generally what you'll find is that people have a strength in one area or the other in terms of buying and selling. So they're either they sell well, meaning they sell losses well. They're very diligent about taking their losses, but maybe they hold on to those profits too long. They're very good with their buys, not so good with, stopping out where they said they were going to stop out, all those kinds of things. And you'll just see repeated patterns, or sometimes people choke off trades too quick. Maybe you're better at holding, your winners, or you're better at holding on to positions, but you hold on to them too long. Right. So studying this stuff is the best way to really improve. And I'm speaking from personal experience. I have found over the years that I am definitely more prone to choke trades off, meaning that I am very diligent when it comes to loss cutting. I am extremely diligent when it comes to if all things being equal, if it doesn't work right here, right now, I want to get out. The downside of that is sometimes I'm often, especially early on, cutting positions just too quickly, or cutting positions on price action that was normal. And that's really what, I often say, you want to cut, ideally positions on abnormal price action, not normal price action. Of course, there's a lot of gray area and art in there in determining which is which, where, I know other traders that are basically, are just the opposite. They're the people that are hanging on to their winners and giving way too much back, off the upside. So it is a balancing act, but figuring out who you are and where those tendencies are really best done in rolling up your sleeves and digging into the truth about their trading. There was a season for a while where this was before, I was asked to come on board as a consultant at MPA. So I want to be clear, I do not do this anymore, where occasionally people would, find me and say, hey, could you do a little coaching or helping for me? And I would often just say, well, sure, send me your trading, send me your metrics. And almost invariably, people either didn't know them or didn't want to do the work to do it. So it almost became this easy way to get rid of people who weren't serious about the business. Saying, well, if you can't even do that and you're struggling, you probably don't have much of a chance, because you're treating trading and speculation much more like a hobby than a business. How many people, run a successful business and know nothing about the level of inventory in their store, know nothing about their profit margins, know nothing about, what items are selling versus what ones are not? I mean, if you and I, ran a department store and that's how, we ran our inventory book, we'd probably be out of business in short order. Trading is no different. And I think this is true regardless of time frame. If you're a short-term trader, long-term trader, even long-term investor, knowing this stuff, I think, is invaluable.
And a quick follow-up question, Mark, there. Once you noticed that tendency that you would choke off trades and not give them quite enough room, what kind of changes did you make about your trading? Maybe you introduced some trading rules. How did you address that tendency?
Great question. Well, the first thing I would say is, and maybe, so if the tendency is, in my situation, to choke it off too early, you could start by not selling all the position, which leads into this next point of being more incremental, or not treating every trade as completely on and off and trading around a position. Because there were plenty of times where I cut a position to what feels like early, and then it fails. But the other thing then is looking at where I would look at to ask myself, okay, why am I cutting this here? So let's say I for sake of argument, I had a stop. It was at 5%, but I decided to choke it off at 4%. Does that make a lot of sense if the stock isn't really doing much more wrong to hold it for that 1 more percent versus just choking it off early? And then some of it really is trade by trade. So then there were certain setups or high momentum type situations where I choked a trade off and then saw the stock turn around and just make a gargantuan move. Well, to save 1 or 2% in a situation like that doesn't make mathematical sense. So let's say you choke off a trade to save yourself 1 or 2%, but based upon the type of situation, it has the possibility of turning around and going up 20 or 30. So you took an inverse relation. I saved 2 and missed out on 20. It doesn't take choking off too many of those to make a huge negative impact on your trading. So in terms of that asymmetry point from before, I just realized, holy smokes, just stick to the stop. Certainly, and I'm talking about, for those, who are more familiar with my style, that highest relative strength type situation, highest momentum type situations. So a little bit it's case by case, but in some cases you might actually, dig into the numbers and while you think you're choking things off, if you study it, you might find out that you're not, that actually, you're doing things well. You won't know though, if you don't really, do some post-trade analysis. And the reality is it's not sexy work, so a lot of people don't like doing it, where I find it comforting too, because even in bad periods, if look, in a good market, I make 2 to 3 times my average loss, and I'm right half the time, you can make an awful lot of money. So that keeps me emotionally in check. It's like letting the stats almost calm your emotions to say, look, you have an edge. Maybe you're not having a good edge right now, which, provides that feedback to either trade less and trade smaller, right, to keep you around and in the game and engaged for when things, really start to turn around. The other thing tracking trades has shown me is that wins and losses are not evenly distributed, meaning sometimes wins come in bunches as well as losses. So there's incredible information in that. Think about that for a second. If you know it's not always heads, tails, heads, tails, heads, tails, that gives you the opportunity to knock off that negative side of the distribution curve by trading smaller and increase the right side of, if you think of it in terms of a distribution, curve or bell curve. So, I would encourage people just to think through that. But as you study it, again, it's what we call, at MPA, letting the spreadsheet come into your trading. Well, if you don't have the spreadsheet, you don't do the work. It has no chance to get in there. So that's, like I said, it sort of leads into my next point in terms of just not treating trading as a complete on and off business. Mm-hmm. So everybody wants to think, well, I'm all in or I'm all out, and that's the way it is all the time. And this is true on a position basis as well as an entire portfolio basis. A lot of the times you're in betweens, or what we call jockeying for position. You're not all in and you're not all out, and you're sort of looking for that clear straightaway where you can really gas it. And this is where it's practice, but we call it, using, Mark sort of coined the term progressive exposure, which you sort of hear being thrown out, and that really is it's sort of the artistic side of the business, in my view, or of trading, where you are trying to expose the most capital when things are really working, and being able to lever yourself up in terms of exposure without just taking more abject risks. See, most people just think, well, if I take more risk, I just make more money. Well, that may be true, but you might also just take a lot more losses, where if you really learn how to do this, you can pyramid your exposure in such a way where you can put yourself in a really powerful situation where you can lever up without taking more risk. This is something we get into detail in the Master Trader program. It's something I get asked questions on all the time. And what I will say is, this is definitely an art, something I'm still working on, something I'm literally asking myself even right now as we're potentially, I'm looking for the next opportunity to really get aggressively long. Well, I'm not just going to wake up one day, get dressed, and decide I'm going limit long the market. That's not how it works. I mean, you can do that, but if your returns are even up, they're going to be extremely volatile, and most likely you're going to get yourself into a whole bunch of trouble. Where if you learn how to really build on success, and use the feedback of the market to put you in a good position, you can really you can take what feels like really small initial risk and then pyramid it into something where you can take just a giant step forward in a very short period of time. And this is really how, if you look at, say how Mark won the U.S. Investing Championship in some of my best years where I had really big returns, that's precisely how I did it. But just encouraging people, though, to start with the idea that you have to be incremental. And this is something that takes practice. It's the same with, a lot of people don't like the simple concept of trading around a position. It's sort of like ground zero for this. Mm-hmm. Most people just like, I want to buy it all in one spot. I want to sell it all at one spot, rather than learning to trade around a position, or get really, you buy a little bit of a position and often it improves. And so for me, I want to buy more. That is, I have learned anyway, very counterintuitive to most folks, but it can be learned. And it's a really powerful concept, because most people think, especially in our case, we're usually always buying more at higher prices. Most people don't like doing that. I can't, for the life of me, it feels counterintuitive to not do that, for me personally, because it's sort of like saying, hey, do you want to bet on the guy who is the best player in the league or the worst player in the league? Right now we're nearly at the All-Star break, say, of the baseball season. Who do you want to put your money on? The guy who has the best slugging percentage, the most RBIs, and most home runs, or the guy who's 0 for his last 40, because you think he's due. I want to put it on the guy at the All-Star game. And that's the equivalent in my mind of adding to winning positions or looking for those situations where you can do so optimally.
And Mark, could you give us kind of simplified example of what progressive exposure actually is? Like, say you're completely in cash in a correction, and then you try 3-4 stocks. What kind of feedback would you look for on those initial positions in order to size up for the next trades? And how do you manage that risk along the way?
Perfect. I am going to actually do that in a second. You're leading the witness, which is perfect.
Perfect.
Because after this last point, I'm going to give what I call the minervini loop that we try and teach folks, and then talk you through sort of a real world example. Just the last point though, which again flows from what I was previously saying, is the idea of the chicken versus the pig. Know when to be a chicken, know when to be a pig. And a little bit of this is, I think, the idea of being a pig. You hear people say, or quoting guys like George Soros and Stanley Druckenmiller, who said, if you want to make really big returns every now and again, you have to be a pig. And what he meant by that is, knowing really when to get aggressive. Most of the time, though, I'm in the chicken category, meaning I'm conservative. I don't want to risk a lot of money. I'm not looking to put a lot of, I'm not really much of a poker player. I don't want to put a lot of chips in every pot, or I don't want to play every hand, however you want to think about it. I want to sit back and wait. It's been even a number of many months since I've probably been even more than 50% invested. Really over, there was one point in the fall of last year. So we're looking at maybe 12 months, Richard. I haven't been more than 50% invested, just counting lots of cash, and on average, it'd be even less, doing very little trading. Why? I'm not seeing what I need to see. And it sounds overly simplistic. This is, again, one of those things easy to say, hard to do. And this is something I'm still trying to get to improve on, and something I think I would definitely say with practice, that if you put these things into practice, this is something you will get better at. Because what winds up happening is you continue to that first point, you go through this process, and then you see situations where you're like, I think I've seen this before, or you get a little bit of that, I don't like to even use the word sixth sense, but it's what feels like sixth sense, but what it really is mastery of something. Mark talks about this in his book, Think and Trade Like a Champion. The idea of mastery, I think he used the example of a violin. Like there were no masters of the instrument that didn't put in so many hours. So by the time you put in enough hours into anything, you are operating on a higher level than anybody else. It's the old, nothing replaces experience. I think Malcolm Gladwell calls this the 10,000 hour rule, that after you put in 10,000 hours in anything, you are operating on what almost feels like a sixth sense level. Well, this is where that, knowing really when to be aggressive, that kind of comes from. So to bring it to your question, this is labeled the minervini loop, but the loop we try and teach people is, okay, stocks, tactics, and feedback. This is sort of wrapped around the strategy and the process, meaning the process doesn't change. The stocks certainly will change. In every cycle, there'll be a different group of stocks. And even right now, the stocks that are sort of, coming across our radar as potential leaders are much different than the ones that maybe we were even looking at a couple of months ago, or certainly a year ago. Anybody who's trying to bottom pick old leaders and all that kind of stuff, that's not what you want to be doing, in my opinion, at least if you're looking for new leaders, because, old leaders don't lead new bull markets, generally speaking. So it's stocks, tactics, and feedback. So, okay, it's as simple as, if I get some stock setups, the tactics are am I seeing these proliferate in terms of low risk entry points, or potential breakouts? You buy a few, maybe it's just one. If you're dipping a toe, you only have to buy one name. You don't have to buy, maybe you see 5 stocks. there's nothing wrong with being a chicken, and you should be a chicken at first. But if you buy one and it starts to work, you got to buy another one. Or more specifically, if you see more, and maybe you see 5 stocks, you buy one, but you watch the other 4, and those are holding up on balance, you're getting good feedback. And then right back around the loop, I see more stocks. You express proper tactics in terms of buying good. This is assuming, of course, you're buying good setups and managing, risk reward relationship. But then the feedback is there, and it just becomes a quickly self-fulfilling part of the process where you go, okay, now I'm really starting to see what I need to see. And to the on and off part, most of the time you're operating between the extremes. You're sitting there going, okay, where are the balance? Where am I in the balance of this loop in terms of what types of setups are working? How long are they working for? This is where last year we had a lot of stocks and a lot of breakouts. They just didn't hold for more than 2 to 4 days tops, maybe. Yeah. And Richard, if you were watching any of this stuff, it was I think we sort of nicknamed it the pops and drops, after a couple of days. And so anytime, which, it was phenomenal for shorter term traders. This was something we were talking about at MPA, and actually, Mark won the U.S. Investing Championship, I think probably trading more trades, shorter term trading than maybe even he had in his career. I was sort of doing the opposite. I was saying, look, I'm gonna play like I normally would, more as a position trader for bigger moves. Well, I would take portions of positions and then wind up getting stopped out on an awful lot of those positions, giving back everything I gained, ideally at break even. So it was sort of, for me, it was a year of 2 steps forward, 1.5 steps back, and jockeying back and forth all year long. But I know if I play the game right, I'm going to put myself in a really good situation. So in terms of, for a practical example of how this works, taking it all the way back, from the beginning in my example in terms of being insulated through the process and what did this really look like in 2020, I just threw up, I tweeted this a couple of months ago. And actually, I tweeted a number of sort of past precedents, all of which were ones I actually traded through. So that's sort of a big thing for me. And definitely one of the things I've always appreciated about Mark in terms of whether it's his books, workbooks. I know for a fact he traded a lot of those examples, and I traded a lot of the examples. We're not just cherry picking great ideas. These are, 95 to 99% of the ones we certainly analyzed, and most of them we traded all of them. So this was the market after the COVID break. And for those who weren't trading, this was one of the worst slides, certainly one of the fastest waterfall type declines, in the history of the stock market, really going back almost 100 years. It was sort of 29 to 87 and then 2020. So to call it unprecedented, it was right on the money. And the reality is things just sort of as quickly started to come the other way. It was April 6th, with a large red hash mark there. You can see where there was a follow through day. And that's where sort of the risk model at MPA went on a buy signal. There weren't a ton of stock ideas yet. And for anybody who was trading this, a lot of V-shaped charts because you had this huge break on the left-hand side and the market bounced kind of hard. And we came off those lows pretty aggressively. But, in this first shaded area, while the index was kind of marking time, this is where you started to see stocks setting up. This is where Netflix and Amazon and some of those even early institutional favorites broke out, but names like Zoom, Teladoc, there were a number that started to set up and work. And that's where I started taking positions. I got pretty long, and it wasn't really, I can't remember if it was there, but it was the second shaded area, though, where it was in the summer. This is really when the market had come back to new highs, and the narrative was highly skeptical, negative, very bearish, as we talked about before. And there were just tons and tons of stocks setting up. Between, May and June, I had made a lot of money. So, the temptation was, hey, kick your feet up, maybe rest on your laurels, and don't take the added risk. But the process said, look at all these stocks. You trust the setups. And this is where, Mark and I have told this story a number of times, because I was just sort of been doing analyst work for him side by side. And I said, I haven't seen this many setups in a long time. But, these things may all fail. And he said, if they fail, they fail. We're buying them. Mm-hmm. You follow the stocks, trust the process. And it actually reminded me, there's a famous story from whatever Super Bowl it was that the Patriots had the largest halftime deficit in the history, or the largest come from behind victory in the history of the Super Bowl, Patriots-Falcons from a number of years ago. And they said that all Belichick said at halftime was, forget the score and trust the process. Well, it obviously worked out well for them. And again, something that sounds real easy, right? But when there's a lot of fear and anxiety and, people saying the world's coming to an end, it's not easy to buy a bunch of names just because they're set up in bases. Well, it's a lot easier when, again, you've got this regular process and there's so many ideas. One of the best signs, though, that I often tell people is when there are more stocks than you have money to buy, that's a great market. If there's one stock set up, Richard, everybody who's doing this has only got one idea, and it's going to be far more failure prone. Yeah. Not to mention the idea that, institutional support is what we really want, right? Institutions that are buying stocks for days, weeks, even months. And this is precisely the environment. What happened? The institutions got rinsed out of the market in March, and here they are just, marching all the way up that right-hand side. Well, when you get these low-risk entry points and consolidations in waves, it doesn't mean that you're necessarily going to make a lot of money, but it is it is really the primary indication for me to get really, really aggressive. And the longer you do this, the more it becomes a little bit of second nature. And this will happen again. The question is whether or not you will be trained, and be ready for it. Because just when you think things are never going to get better, this market, it's terrible, and you're starting to hear this even now, you'll get a rally, no one's going to believe it, and then you'll get either a bunch of setups or what we call a wave of these opportunities. And the majority of people will ignore them, and those people who really practice progressive exposure, think risk first and putting themselves in asymmetric situations and aren't afraid to be insulated from the crowd, are going to do really, really well.
Perfect. And before we get into that, I do want to come back a little bit to the nuts and bolts of progressive exposure. And if you could just kind of talk about, when you're first coming out of cash, what's kind of your starter position size and how quickly, based on feedback, will you kind of ramp that up to full positions when you see all the stocks following through, the market's improving, there's more and more setups? What do you kind of do?
It's different a little bit every time. So it depends on, normally, every time we get some type of valid accumulation day, and this is something that I learned from David Ryan at one of the Master Trader programs. He has what he calls a mental health buy, or that he termed, meaning if you get an accumulation day, you have to buy something. I put that in my notes because sometimes I would wait, and then none of us know, Richard. Like, people think you have this clairvoyance of that, like the market isn't going to tell you which one's the real low or what's the real follow through day. And sometimes you get a follow through day. And like I said in the prior example, and there aren't a lot of stocks, right. But if you buy something, and this is position relative, for some people that might be a really small position, a couple of percent. For others, they might take one bigger position, but they're not going to add any more if that one isn't working. I've done it in both ways. It depends. Sometimes if I think maybe there's what looks like a key leader to me on a follow through day that is, or right around an accumulation day in the market like that is breaking out, I might just take one position and take a little bit bigger position in that, where I'm saying, look, if this can't work, nothing's probably going to work here. So I'm going to put, for lack of a better word, all of my chips, at least for my first little foray into the market, into this one stock. I wouldn't normally do that. I would normally see how many setups are there. But usually I'll try and buy one or two names. And I have found, and if you look at this again on Twitter from some of those past precedents, and I think I tweeted 6 or 7 going all the way back to 2010, every one of which I traded, where I used sort of those shaded areas to say this is where I was getting really aggressive. Most of them were, days to weeks after those accumulation days. But what got me to getting really aggressive was whatever I had bought in that interim period was working.
Right.
So normally, though, I would not get beyond 20 to certainly no more than 50% invested within a couple of days. But I have gone from full cash to fully long in the span of probably 2 days before. But that wasn't usually right off the follow through day. I might have bought, a name or two, and then all of a sudden there was just a lot of setups. So let's say I buy that 1 or 2 names and they're working, I am going to lean on those profits. And what I mean by that is I'm going to say, so if initially I'm going into the market with maybe I'm going to risk 1% of principal on buying 1 or 2 names, and they start to work, rather than going, hey, great, I'm up 1 to 2%, I'm going to risk all that to put on that much more exposure. And this is where progressive exposure comes in, where I will potentially move either stops up, either in my head or I don't usually generally have resting stops in the market in such a way to say, okay, now if I've got more setups and is there open profits I can lean on, I'm going to use that to pyramid up my exposure the same way where I talked before about pyramiding a single position. I'm looking to pyramid my whole account.
Mm-hmm. And I think that's a question that's often asked, like those initial positions where you make progress. You talked about just moving up your stops, but some people kind of wonder, should I sell those initial positions and then transfer that money? Or it sounds like you just kind of move out the stops and that's how you manage that risk.
I've done it both ways. So early on, I was less of a position trader. And what I mean by that is I was more of once I got to a multiple of my average loss, I just kicked the trades out. And there was a variety of reasons for that. One being, big believer in never underestimate small gains compounded over time. That's the easiest way to compound returns. However, as the account grew and liquidity became more of an issue, and I learned more about how to identify potentially bigger winning stocks or play them for bigger moves, I adopted, a few more tactics, same entry points, but just saying, hey, if I can sell a portion of the position, finance the remaining shares and try and play them for a bigger move. And what I noticed, though, is my win rate actually over time actually went down, but my average gain went up to compensate for that. And my number of in and out trading also went down a little bit. Well, as your account grows, it's not necessarily required, but it's a lot more difficult, when you're managing millions and millions in terms of an account versus when you're managing a few 100,000. This is a point, though, I would make, and that Mark always makes, like, the little guy doesn't have a disadvantage. He has an advantage.
Right.
You have a huge advantage over the institutions. You can get liquid. And this is true even if you're managing, 50 million, 100, even a few 100 million. The liquidity advantage you have over larger institutions is enormous. You want to put that on your side. So you don't want to have to hold through these, big downturns. We flashed a sell signal back in November of last year, telling people, hey, you should be holding lots of cash. You don't have to hold like a lot of these institutions do. And some of them are literally mandated to hold. think about that. You have to hold into a declining market. That's exactly opposite of what the individual investor and trader should be doing. The reality is they don't have the skill set to know how to do it properly. And that's, it's something that really can be learned. The idea is, you want to know when to use cash. You don't just use cash. It's the idea of the knowledge of when to use it, and cash is a position.
Absolutely. And getting back to kind of coming out of a large correction where you're completely in cash, and say there's 20, 30 setups, stock setups are everywhere. How do you narrow your focus on just a select few? Is it completely kind of price and volume based characteristics, looking for VCPs, or do fundamentals also come into play? The story, the theme, the earnings growth, all of that. What's kind of most important to you into finding 5 of the best stocks setting up?
It's everything you just mentioned. Ideally, relative strength, and then and earnings and sales. Mm-hmm. So yes, I have, and again, back to the point about tracking trades. My biggest winners have come. Call it ironic or not. Mark talks about this in his first book. We also talk about this in Master Trader program. My biggest winners have come from some of the classic growth areas or growth groups. Mm-hmm. So I tend to favor those, not favor, just because I like one stock or the other, because my results have said this is where I've made the most money. A good example of a group I don't traditionally favor has been one of the few groups that's been working this year, until recently, were the cyclicals and commodity names. Right. My record in commodity stocks is not very good. Even when they set up, I know some people might say, well, commodities haven't had a really good bull market. Well, we've had a good bull market. I have traded some of them. I've made a tiny bit, but even this year's been a good example. Been a lot of work for a little reward, at least for me, where I would much rather prefer something like in the consumer retail group with high earnings and sales, because that just, historically speaking, and this isn't the last 10 years, this is studying the biggest winning stocks in history going back to 1900, the power and momentum behind those stocks, if they're timed right, is much better than, say, something that's a deep cyclical.
Absolutely. And we've talked a little bit about progressive exposure to the long side, but can you talk about, when we're a little bit long in the tooth in an uptrend and leaders start breaking down, how do you kind of use feedback in your statistics, your average gain, average win, average loss, in order to tell you to kind of size down and kind of naturally become pushed to more and more cash?
Well, the biggest thing is back to the trading loop, in terms of just feedback. Mm-hmm. If I'm getting bad feedback at any time, think of it this way, if the wind is pushing against me, and that is I'm getting stopped on trades, or trades that we're working are giving back more than I think they should, or starting to act abnormally, I am taking that as an immediate caution flag. Mm-hmm. And this is where, again, we used the example before, hey, you're coming from cash looking to get more aggressive. Well, the same thing comes if I'm fully invested, or even more so, say I'm really aggressive and on margin and feeling pressure, I am going to heed that pressure even quicker. Mm-hmm. I'm quicker to protect myself than I am to get aggressive on the long side, if you follow me. Yeah. And this is something I've definitely learned. Some of my biggest drawdowns have come from not heeding that quick enough, meaning that the feedback the market is giving me is telling me that the winds are changing, and sometimes people sit there, they're trading at bigger size, they take 2, 3, 4, 5 stop outs in a row before they start reducing their size. That's not how I'm doing things. I'm looking to aggressively pull back just as fast. The other thing I would add, though, is that it's sort of the same principle when, if you're, like you were saying, hey, maybe you're in a good period and things are really working. Mm-hmm. If in terms of back to stocks, if there's very few setups and everything's now extended, hey, they're working, but they're extended. Right. That's telling me stocks then can be acting normal, but if I'm very long, they're going to put me under a bunch of pressure. And if that's more pressure than I want to take, I've only got one choice. That's to start reducing. Not because I and this is the way professionals think, people, they fall in love with stocks. And I don't want to sell this one or that one. Well, I don't want to give back too much money. So you got to ask yourself a series of questions, meaning if all these stocks I'm long act normal, and that's going to and you just run some basic math, that's going to cause too big of a drawdown that I'm not comfortable with. You got to move, you either trim positions, move up stops, or both. And that's exactly, I usually do both.
Yeah. Perfect. And we talked a little bit about how 2021 was very, it really favored short-term trading almost, a few days. The breakouts, barely lasted. But also back in 2020, position traders and longer-term investors were really rewarded because there are long trends that really lasted above the 50-day moving average. How do you kind of stay in tune with, the tactics and themes that are really working in a certain market? And do you kind of alter your style to kind of reflect and kind of favor that tactic versus, just sticking with one thing and trying to force your will in the market almost instead of kind of listening to what's working?
Well, I would never try and, force my will on the market. That's for sure. But generally now, I'm more of a position trader than I am a shorter term trader. Mm-hmm. So if that's not working, you have to be willing to sacrifice one for the other. Mm-hmm. So right now is a good example. I'm trying to key in on where do I think the key leaders may be. Mm-hmm. I know I'm not going to catch everyone, but I don't need to catch everyone. That's not my goal. My goal is, to make good risk-adjusted returns and to generate real alpha over time. So I'm sitting here going, okay, what are the stocks that I think are showing really good relative strength, good potential fundamentals in a market that's been very difficult? So if the pressure comes off the general market, those stocks will potentially soar even higher. And that's, now I will still potentially sell portions of those positions when they get extended to finance a larger hold. I'm not just going to plow in to the full on-off, that trading's not an on-off business. I'm going to try and smoothen my equity curve if or when possible. But I'm sort of a hybrid, where if I trade out of a scale of a position, it's so that I'm using that to finance that bigger hold between sort of your longer term, or maybe more of your classic can slim investor that's really just trying to catch that key leader and ride that baby all the way. Yeah. And someone that's a much shorter term trader, I'm a little bit of a hybrid between the two.
Perfect. And getting into, tracking your trades, obviously your average gain, average loss, your batting average, those are kind of the most important metrics. But I was wondering if there's anything else that you really track that you find really valuable and traders you think should really keep track of it. And also if you kind of take notes along with that trade about kind of the market conditions at that time, what the kind of situation is. I'd love to hear more details about, what do you actually put in when you track your trades? Sure.
Well, what you said is obviously, really important. The other thing I would encourage people to do is average days held, for your wins and your losses. And then the other thing you can do is actually put in, either in the notes, or some people like to just have maybe have a name for the different setups. Because that either tells, one, it can tell a couple things. One, if there's sort of a technical theme in certain periods of the market where maybe you see, hey, there's a lot of handles forming, or handles are what's been working, versus, in other periods, maybe it's cheat areas or, those types of things. But you can also then see, do you actually trade certain setups better than others?
Right.
Some people, just are more comfortable with certain setups, and that's fine. Again, that's just a reflection of your personality.
Perfect. And at the time of a trade, do you kind of take a screenshot of the chart or print it out or anything for reference later? Or is that more when you go back and look at your trade, then you'll kind of pull up a chart, mark your buy and sell, and look to see if there's any improvements to be made?
That's not something we do in terms of taking screenshots in real time, but that is definitely a good idea. And it's something we should do in terms of, and there's a good reason for this. One, it's an easy way to sort of build model books of your own trading.
Right.
We have started to go through after and create them for some of our bigger winning trades or trades that really look like textbook, so that you can really, again, create your own model book, of knowing what it is you want to see, knowing what you've done in the past, so that when you see it again in the future, you're ready. But what I was going to say is that there's nothing there's nothing more frustrating than going back through and looking at trades and the symbols don't exist anymore. Because what will happen is if you do this long enough, eventually some of these stocks, either the symbols change or
they get acquired.
They get acquired, they go out of business or whatever, and then you don't have, it's actually really tough to find delisted symbol stock charts. And so I started noticing like, what happened to that? I used to have this great example, now it's gone. So it's nice to have those, and screenshots are a really simple way to do that. So no, that's something that we will be incorporating.
Perfect. And do you actually kind of print out the charts, physically mark them up, or do you keep everything digital and in your charting software?
In the past, I've just kept everything in Excel. And like I was saying, starting really, I want to say in 2019 or 2020, we started going back through and creating a model book where we sort of took some of our big winners and then we printed them off. So yes, to the point earlier, where if those stocks go away or don't exist anymore, similarly, you look at some of O'Neill's old books or even some of Mark's trades in his books or in say the seminar manual, some of those stocks aren't around anymore, but you've got these picture perfect entry points, buys and sells that you'll always have.
Perfect. And I've asked you in previous interviews and presentations about this, but I think, going to the fact that process is so important, I'd love to hear you talk a little bit about kind of your weekend routine and also your daily routine afterwards that kind of sets you up for success, that keeps you in the know about, are stocks setting up, are stocks following through, or are we kind of seeing, movements to the downside as well? So first, kind of talking about your weekend routine, could you kind of talk through the steps you take and any screens that you run and how do you basically find and determine whether stocks are setting up?
Sure, it's very simple, and I've pretty much been running the same screens since 2010. I've changed almost nothing. I run a basic relative strength screen, composite screen, and an IPO screen every day. And then I run over the weekends a few additional screens with some fundamentals. And you and I think have talked about this in the past. There's no magic about the screens. Depending on what type of market we're in, it's usually between 500 and 1,000 stocks that you run through. And then it's just simply looking for potential viable candidates. And then normally it's developing a series of watch lists. Mm-hmm. Mark uses the language sort of like in baseball, like ones that are on deck or high on deck, or, if you think of it in terms of names that are, close or really close. And, we've always just used, primary and secondary watch list. And that's all of our ideas. Anything I'm going to trade is going to come from those watch lists. So it's been on the watch list first. And then that's something, we go through every single day. Mm-hmm. And then Brandon and myself we run those screens every day. Again, a little more screening over the weekend. And then we compare notes in terms of our lists to make sure, second set of eyes, right? Like, did I miss anything? Did you miss anything? What are we seeing? And then that's what we're working off for, any given day. And what you find is that running through that routine, while it may feel arduous or boring, it gives you an amazing feel for what the market's doing.
Right.
People may find this skeptical, or again, like I talked about in the beginning in terms of process, but that really is the process. I mean, I'll look at general index charts in terms of, like, did we have accumulation distribution, but I'm not studying those. I'm studying, what is the market telling me? Think of this in terms of, I'm trying to stay agnostic and let the stocks pick me. If you do that, you're going to put yourself in a really powerful situation eventually. Might not be today, might not be tomorrow, but if you continue to run through that process, eventually you find yourself in these periods where you just go, oh my goodness, look at all these great ideas, or you find these themes where people love to have, I want to be long this group of stocks. For whatever reason, they come up with some fundamental narrative. That's all great, but I'll get long that group of stocks when they set up and meet the criteria. And sometimes there are names I've never even heard of. Like, well, who are these guys? Oh, they're in this group, and but they're setting up. And then sure enough, you buy them, and the stock just takes off. While some other group that maybe you thought you wanted to own never ever sets up. So again, letting the market guide me rather than digging in and having some type of macro fundamental opinion on why some group or some stock should be working.
Perfect. And also, going along with your daily routine, what do you kind of do from the moment you wake up to, set yourself up for success? So you're focused, you're ready, you're confident, you've got all your alerts set. What do you kind of do to, prepare for the market open?
So for me, I actually usually I start work about an hour and a half before the open. In terms of, if you want, like, when I get out of bed, I usually get out of bed about an hour before that. I spend the first 30 to anywhere between 50 to 60 minutes in personal, like, quiet devotional time. Usually some type of, Christian scriptural reading and prayer, meditation, that kind of thing. I do exercise sometimes in the morning. Normally, though, I do that in the afternoon after the market closes. I'd rather work off any of the negative or positive, emotions from the trading day in terms of exercise later. But sometimes we'll in the morning as well. And then, we generally then start at, 7 a.m. Central, just going over what are our lists look like for the day. What's the battle plan, running any sizes, putting in any alarms, and those types of things.
Perfect. I've got some more questions here that people kind of submitted in advance. So the first one I think is a pretty interesting one. If you had to start all over right now and you had kind of $200 to spend on resources that would kind of inform you, what would you kind of spend and invest that money on?
I wouldn't do anything any differently. I often joke, or say, that there was less, and I'm not that old, right? But there was less when I was getting started than there is now. That's for sure, because the amount of, of things on, just online in general, was far less. Now, I know there's a lot of things online that I think are probably not worth much, but, for me, even prior to, look, the way I found somebody like Mark was reading Market Wizards. I probably read some of those Market Wizards interviews 30, 40 times.
Yeah.
Those were the Bible as far as I was concerned, because these were people who had done what I wanted to do.
Right.
And, which is why even I didn't have much money. The first seminar I went to, I'd made, I don't know, 10 grand or something like that, trading stocks the first half of 2010. And I think I used most of that and those profits to pay for a subscription to minervini Private Access, and then to come to the seminar. I mean, so I'm a big believer in, markets are going to charge tuition. And there's nothing wrong with knowledge is invaluable, meaning you can't put a price tag on, learning priceless truths about anything. By the way, this is the same way I've approached anything I was interested in. I was a student of philosophy, at university. You had to do nothing but read, read, write, and regurgitate whoever it was you were studying. If you want to be, good at anything, you're going to have to commit yourself. It was the same thing, even whether it's podcasts. I was in the MPA training room for a decade, every single week, asking questions. So when I'm amazed at the number of people who even sign up. There's a slide here on just the service and the value. And like I said before, I'm amazed at the number of people who don't even come to the weekly Q&A sessions. They pay for something and don't get the real value of the education. There's no shortage of amount of reinforcing good things. Reinforcing the good habits and these timeless principles. That's the real value. That's what's going to be around long after Mark's dead and gone. I'm dead and gone. There'll be other people preaching, teaching the same stuff. If you read what Livermore was talking about, 80 to 100 years ago in How to Trade Stocks or reminiscences, these same principles are there. And they're not going to go away.
Perfect. And looking at your performance, I think what really stands out to me and what's really clear is you're able to keep your yearly drawdown really low. Like you're able to come back you don't stray too far off all-time highs. So can you talk about kind of why that's important in terms of compounding account and building your capital over time?
Sure. And this is something, I've learned in the trenches, is that the more you can control your drawdowns, the closer you can stay to new equity highs or new all-time highs, the easier it is both financially and emotionally.
Right.
This is why when things aren't working, it's not, listen, you're going to have drawdowns. There were, one or two of those periods even where, I could have done a much better job managing that downside, which is even why in the period I've been in now, I'm in a small drawdown now. And I often say to people, you want things to feel worse than they are.
Right.
And I don't know if we've talked about this before, Richard, but when it comes to emotional capital, I want to feel like I'm bleeding out emotionally before I am financially, where it's like, man, I just cannot get any traction. And you're down a couple percent. That's perfect. Because then when things turn around, you're going to be just like a good stock. A good stock is making new highs very quickly. It might pull back 3, 4, 5, 6 days, and then boom, 1 or 2 good days, it's pressing new highs.
Right.
Same principle, if that is how you want to manage your portfolio. Again, easy to talk about in theory, but in practice, it's something, that can be done. Just to be clear, the track record is it's audited and presentation for skill only. We're not advertising outside money management. We don't do any of that. That's mine and Brandon's proprietary internal track record. But the other thing I would say is, I think, while we've grown quite a bit, we've gotten better. It's a skill. This is a skill game. No one's born with it. I'm not saying it may not suit better people's personalities more so than others, but if you've got the passion and the drive, it can really be done. And this is one of the reasons why why am I doing this? I decided really about a year and a half ago that instead of trying to make the most money, and even managing a slug of outside capital, I think I'd rather try and pay it forward, if you will. And for those skeptics, oh, why are you guys charging money? All that kind of stuff. It's like the best coaches in the world find their best students because they're the ones who are really dedicated, and that comes with a price tag. The best universities are no different. So that's what I would say. In terms of the drawdowns, though, it's just they're a part of the business, but the more you learn to control them, and even if you sort of want to look at this, our own numbers, it's like our drawdowns have gotten smaller while we've still had some big years. I mean, in the last 2 years, we've had really good upside with very minimal downside in the middle, and that's to me that's the measure of trading skill. It's not even total. Anybody can have a big year, And lots of people had big years in 2020, and
Mm-hmm.
they gave them all back, and in some cases a lot more right now. Where if you can make a lot of money in the good times and find a way to mark time or give minimal amounts of it back, and that's really how you can make a life-changing amount of money.
Right. And talking a little bit about your equity curve, do you kind of analyze it similar to a stock in terms of, looking at the spots where you've got a spike in equity curve or a dramatic pullback, and kind of think about what were you doing during that time? Do you kind of look at it that way in terms of post analysis and try to obviously do more of what causes spikes and do less of what causes drawdowns?
I don't get too
Granular.
yeah, well, I don't get that granular about it. And even when it comes to the numbers, like there are times and normally this is in the better months, in good periods. Sometimes I don't know how good they are. And I don't mean that like I know intuitively when things are working, but there have been times where when it's a good market, our heads are down and we're focused on the trading. I'm not even checking, I know guys that, they check their NAV every day. I don't generally do that. But then there are times where in a really good period, I'm checking like, holy smokes, look, we've had a better month than I thought, or, because you're playing the game, you know what I mean? Rather than obsessing over every point or every play or how, whatever, if you have a sports background, that kind of thing.
Yeah.
I think Mark describes it like in pool, you're just running racks.
Yeah.
You're in the zone, would be the way other people would put it. So yeah, I wouldn't get too obsessed with it, at least for me personally. The goal is, again, when things aren't working, I want to scale back as quickly as possible. The other benefit though, in terms of studying your results is knowing that, hey, if a good month for you is, double digit month, and you can keep your drawdowns, even your worst drawdowns to near double digits, you're only a month or 1 or 2 good months away from being right at new equity highs again. You can go a long period of time. And that's the question I have gotten is, well, how did you get through those periods? Well, you looked at the good periods.
Mm-hmm.
You said, well, my goodness, it's only going to take a little bit of time in a good period to make a substantial amount of money. But this plays into, people's emotions. That's hard to do. Some people want trading to be like a salary. Mm-hmm. Well, if that's what you want, you probably need to be more of a shorter term type trader, where you're just trying to grind out, maybe a certain amount of money every day or every week. There's nothing wrong with that. That's not my style. And there are plenty of people who can make a good living doing that. And I think you can use you definitely use the same type of principles and even the same type of setups. You're going to have much tighter, much smaller losses and smaller average gains.
Perfect. And this is a little bit of a fluff question, but I'd be interested in your answer. What's your favorite trading quote and also why?
Well, I don't think that's fluff at all. I think that's a great question. Man.
I borrowed it from Alyssa Corum, so shout out to Ali Corum at IBD. So,
I guess I would say, well, it's a tie, maybe. Never underestimate small gains compounded over time. Would be one. I think that's from Gerald Loeb, but I heard it from Mark first, and I didn't fully understand it at first. The other would be probably from my dad, pros take losses, everyone else loses.
Nice. Yeah, I think those are fantastic. And my last question for you, Mark, thank you so much for your time here, is what general advice you have for traders, during this time, during this corrective state? What kind of can you say to inspire them and make sure we're all ready for, the next batch of huge market leaders that are going to come out eventually of this bear market?
Well, back to the beginning, this is where you have a golden opportunity to really work on being insulated in your process. Yeah. Because if you're focused on, one, things have been terrible, or, this is garden variety bear market type action as far as I'm concerned. The difference has been maybe, some of the tails on some of these names, like in the NASDAQ, have been really bad. To me, that just gets me excited, because it just tells me that, the market is weeding out the undisciplined. And that should be music to your ears. But, in the specific environment, let's say things get really bad economically, and or like I said before, maybe the headlines start to get really dire and all that type of thing. At some point, a bull market is going to be born, and you've got to be prepared. I don't know when. I'm the first one to admit that. That's the whole idea of having a process, but it is definitely going to be worth being ready for those who put in the work. So yeah, bull markets are born out of recessions. So don't be afraid. Ignore all the, everybody else who says, it's different this time. And, the only thing that's different this time is the fact it's just the things that are the reasons they're giving for why it's different this time. There will be another bull market, and it is going to allow a number of folks, probably a small group, to make a real meaningful difference in terms of their financial future.
Perfect. Well, Mark, thank you so much for taking the time and speaking with us today. I'm sure everybody watching is really enjoying it. Make sure you leave a like on the stream if you are. Mark, where else? Obviously, you mentioned minervini.com. Where else can people kind of ask you questions and connect with you? Also on Twitter as well, I'm sure you'd like to mention.
Sure. Obviously minervini.com. If you're interested in Minervini private access, fortraders.com for, the upcoming Master Trader program. That's going to be online. And then, I'm on Twitter at Mark Ritchie _ Roman numeral 2. And, look forward to hearing from anybody if they have any questions.
Perfect. So we'll leave it there. Thanks again for tuning in, and we'll be right back. Take care.
Thanks, Richard.